Good morning. It's Friday, June 7th, about 6 a.m. Central Time. Overnight, the precious metals are getting hammered after yesterday's relief rally. As we discussed in Thursday's Metal Minute, part of yesterday's rally was partially technical, where gold punched through a series of consolidations. Silver maintained its bullish trend. Copper failed to follow through after breaking through on the June 4th sell-off, where it went bearish trend. There was no continuation down, and it continued to hug the 50-day moving average. There was an uptick in initial claims, and that kind of threw fuel on the fire and helped spark the explosive rally. So what the heck happened overnight? We're getting hammered over here on these precious metals. So overnight news broke from Chinese sources that the People's Bank of China would end its gold reserve purchases after 18 straight months of inflows. This reminds me of Monty Python when the Black Knight gets his arm chopped off and says it's merely a flesh wound. We must take this development seriously and reflect on when those purchases started and the price of the futures on where they were trading at 18 months ago. And as I was writing this kind of script here for the Metals Minute, I went back and looked, and I was shocked to no surprise that in November 2022, gold was $1,650 to $1,700 an ounce. So could we return to those levels? I mean, geez, we're going to have to really look at this and kind of reassess how big of an impact these Chinese inflows are. Now, there's many other developments out there. I mean, the relentless money printing, the excessive levels of debt, the geopolitical risks, the growth, the green energy story. There's a ton of things that are just, on the back to help support this market right here. But is it really to that level where it is? The arm got chopped off. So we're going to have to really pay attention to this. So this kind of brings back the old saying in my head where there are old traders and there are bold traders, but there are no old bold traders, meaning that it's active risk management that really helps project the longevity of futures traders out there. And it becomes too easy for people to hold on to losing trades with the hopes that the market will turn around rather than admitting that something seriously structurally had changed or admitting that just simply put you were wrong and the trade did not work out. So it's really important to practice active risk management. And a quick lesson that traders must remember that there are like the 5,000 ounce contract on silver, there's the 2,500 ounce contract on silver, and there's also the 1,000 ounce contract on silver. There's well as options that are completely liquid that are on different durations. There's weekly, monthly. There's the ones that coordinate with serial months, the ones that coordinate with the most active months. So there's no excuse for not having some kind of risk management place for these particular markets. Now, something that people could do is you can also, use a technical level and put your stop loss at that level. You can also use different approaches, like looking at what was the last 10 days and where was the low there. If the market breaks through that, like on something like gold, if you look at it, it consolidated sideways for a period of time, broke out to the upside. Perhaps the 10 or the 20-day low would be a great stop because of the fact if the market breaks through that, it could be starting a whole new trend. Now, something else, and this is something I actively use, is if you look at the average true range on something like gold, which it's like $36, take 2 times that just for your arbitrary stop, $72, put it down there. Chances are if gold corrects $72, something seriously had changed in the market. Now, today we're going to see non-farm payroll, which could cement the Fed on when they're going to make their first interest rate cut, if they do it at all. You look at the July meeting, 16% chance. You look at the September meeting, it's like a 65% chance. The expectations are for 182,000 jobs to be created versus 175,000 last month. So we really want to see kind of that uptick here as far as jobs coming in on the low end. We want to see the 165, the 150, or even lower in order to pull forward those expectations. A blowout number like 225,000 could be a train wreck and a disaster for some of these metals markets. And I don't mean to be so gloom and doom. It's just you get these kind of euphorias where, hey, gold broke out yesterday. Silver was up $1.30. Man, we were feeling great. Copper was recovering. And then all of a sudden, it's like the rug gets pulled out from underneath you and the gut punch comes in and you see something like this on the day. So other outside markets, you do have crude oil just a bit higher. You have Bitcoin just a bit higher. The dollar index about unchanged on the day, and U.S. equities under some pressure. Many people are looking at the Japanese yen as this hedge, which quite possibly could be if some of these markets really become derailed. People will fly into the Japanese yen and consider it the safe haven of old days, and the market rallies. And the options are fairly liquid and fairly inexpensive. So it is a good solution in my opinion. If you got any questions, reach out to me, 312-858-7303. Remember, futures and options trading involves risk of loss, may not be suitable to all investors. Good luck, good trading.